to the 10 Commandments of Raising Venture Capital, being hosted by Stephen Hoffman, founder and CEO of Founders Space.
Wonderful to be here, and thank you for having me. My name is Steve Hoffman, but in Silicon Valley, they call me Captain Hoff because I am the captain and chairman of Founders Space. For those of you who don't know, Founders Space is an international startup incubator and accelerator. And today, I'm going to talk about something I know a lot about, and that is how to raise capital for your startup. First of all, I began as an entrepreneur. I did 3 venture-funded startups in Silicon Valley. So I have a lot of experience on raising capital, everything you need to do and everything you shouldn't do. And I'm going to share some of those insights with you. I'm also the author of several books. So my first book, Make Elephants Fly, is all about the process of how startups innovate, how you come up with that big idea and make it fly, even though it seems impossible. My second book, Surviving a Startup, really goes into detail on what we're talking about today, raising venture capital. Now today, I not only coach, mentor startups, hundreds of startups, and run incubators all over the world, but I also invest in startups. So I've sat on both sides of the table. Now let me share with you my PowerPoint and we will get going. So Founder Space began in 2011 with the mission of helping startups globally. We have actually expanded. We now have over 50 partners in 22 countries around the world, and we continue to expand. Founder Space has actually been written up in a lot of different publications, and Forbes magazine ranked us the #1 accelerator for overseas startups. Entrepreneur magazine also ranked us #1 for overseas startups. And I am the author of the 3 books, Make Elephants Fly, Surviving a Startup, and my new book coming out this summer will be The 5 Forces That Change Everything, which is about the future and how technology will change all of our lives, everything we do on this planet, and even the human species. So let's dive in to the 10 commandments of raising venture capital. #1, investors want elephants. If you come to Silicon Valley and you want to raise capital from a venture capitalist, they want your company to be huge. They don't want mice. They aren't interested in investing in mice. They're not even interested in investing in deers or hippos. They want something that will be enormous. Now, for you to understand this, you have to understand how venture capital firms work. They work on a hit-driven model. That means that they have a portfolio of startups, let's say 10 startups, and they are betting that one of those startups becomes such a big hit, the next Facebook, the next Google, the next, you name it, becomes such a big hit that when that IPOs, it pays for all the other startups. In fact, in most cases, all the value of the other 9 startups doesn't even come close to the value of what they call the fund maker. So every venture capitalist in Silicon Valley, if you go to them and you ask them to invest in your startup, but you show them an opportunity that is too small, they will pass. Even if it's a good business, even if it's guaranteed to make money, they will pass because it doesn't fit their model. This is something you need to be aware of because I see too many entrepreneurs that have a vision that's too small for venture capital. They might be right for other types of capital, but not venture capital. #2, sell the future. Now, if you're going out there to raise capital, you can show them what you have today. That's really important. But you also have to spend a considerable amount of time showing them what your company will be in 3 years, in 5 years, in 10 years. They want to see the future. Remember, investors aren't investing in your tiny startup at the beginning, at the early stages, for what it is today. You know, you probably have very little revenue, if any, very few users, and not a lot of growth. So they're looking at this, and for them to get excited, you need to paint a picture in their mind of what your company will be years from now. So the really good entrepreneurs out there are like Elon Musk. Elon Musk didn't start SpaceX saying, we are just going to try to build a rocket ship that's as good as NASA. They didn't say that. Or we are going to be a company that independently launches satellites for profit into orbit. He didn't say that. He didn't even say we're going to be the #1 satellite company in the world soon. He said we're going to Mars. Like, that's what he said. Now, that's an extreme example, but it's the type of thinking venture capitalists want to see. They want to see where you're going. If you're Jeff Bezos and you're pitching your company, you may say, we're going to sell books today. We're going to start with books because they're easy to ship, because people understand them, because we know there's a market for them. We're going to do books. However, someday we're going to sell everything. That was in Jeff Bezos's mind, although he started very narrowly. But venture capitalists got excited. Not only could this company potentially be the biggest bookstore in the world, but there's a path even further. Number 3, when you go to pitch venture capitalists, one of the first questions they'll ask, if they're interested, is what's your valuation? What is your company worth today? And I get this question all the time. You know, entrepreneurs, they don't know their valuation. So how can I pick a valuation? I mean, my company hardly has any revenue. I hardly have any users. We're just beginning. We have some technology and a great team, but what is that worth? Well, I'll tell you, nobody knows what your company is worth. That's the beauty of it. It's worth what you say it is, but more importantly, it's worth what people will pay for it. And you won't know until you go into the marketplace. Now, I compare valuation to a home buying. Like, if you go to buy a home in a neighborhood, what is that home worth? Well, the same exact home in one neighborhood and in another neighborhood across town could be worth radically different prices, radically different valuations. And in another city, that same home will be a different valuation. The same is true for startups. Your startup's valuation will depend on geographically where you are. If you're in Silicon Valley, valuations are high. If you're in Beijing, valuations are high. If you're in Estonia, valuations are lower. So valuations shift because it's all supply and demand. How much capital is chasing how many deals? The more capital chasing the fewer deals, the higher the valuation. So how do you find your valuation? Simple. You start going out and looking at what other similar startups in your market are getting funded. You can find this information out by talking to venture capitalists. What deals are they seeing? Other entrepreneurs, especially lawyers. Lawyers are doing the deals. They're writing the contracts. If you get a lawyer who's plugged in, they could pretty much tell you your valuation. Other resources, AngelList. Go on AngelList and actually look up. If you register as an investor, you could actually start to see the valuations of all the different startups on there. And you can start to get a pretty good feel for what your company is worth. Know your competitors. So this is something too few entrepreneurs spend time doing. And you really need to do this from the get-go. You need to understand everything about your competition. It's not enough to make a little chart showing you're in this sector and your competitors are over here. You have these strengths, they have these strengths. That's not enough. When I go to invest in a startup, I always ask them about their competitors, and I expect them to go into detail on exactly what their competitors do well, where their competitors fall short, and how their product, their company is going to totally beat this competitor in the market. You should be spending as much time on your competitors' products as your own. You should be using them every day, every week. You should be analyzing them. Your entire team should be all over your competitors. If they are innovating on something, you should be the first to know about it. If they are using a new marketing strategy, you should be the first to know about it. You need to understand your competitors. Now, we look in the world today, really smart companies really know their competitors. So if you haven't spent an inordinate amount of time on your competitors' products, really analyzing them, becoming a power user, and then taking away everything that they do right and incorporating it into your product and looking for what they don't do, gaps in their product, things that people really need that they aren't delivering so that you can deliver them. Number 5, investors need data. It doesn't matter how great a vision you paint. It doesn't matter how smooth a talker you are. At the end of the day, really smart investors want to see something to back up your words. Why is what you're saying true? Can you show me some proof? Now, at an early stage, it's difficult. Later on, as you grow, you could show them your growth, your revenue growth, your user growth, your engagement. All of these metrics are really important. At the beginning, though, you might not have that. So what can you show? Well, you can actually go out there and manufacture your own data. For instance, if you are selling to other businesses, you can go to those businesses and engage them. You might not even have a product completed. You might have a prototype or even just a PowerPoint or a video, but you can go there and you could show them what you have and get their reaction. Then try to get a commitment from them. Will they sign a letter of intent? Even better, will they fund a pre-order for you? Or if you can't get the money, get a video. Set up a camera and record their reaction once you pitch them. How are they reacting? Are they excited? Do they really need the product? Will they testify to this? If you can go into investors and cut together a short clip, maybe 1 or 2 minutes, of all these potential customers talking about why they need your product and how excited they are that you're developing it, that can be enough for investors to say, wow, there is something here. Seek advice, not money. When you go to talk to investors, a lot of times entrepreneurs will be focused on, give me the money, I want to close the deal. They're always trying to sell. But honestly, in the early stages, the most valuable thing you can get out of investors is not their money, it's their brain power. Now, investors, especially successful ones, tend to be really tuned in to the market. They can see things that you might not be able to see. They're looking at a much broader spectrum. They're looking at all these companies. They also have a very long history. If they're an investor and they've done well, they've invested in a lot of startups over time. They've seen a lot of things you haven't. Many of them have been entrepreneurs themselves and know what it's like. So in essence, when you are pitching them, this is your opportunity to actually pick their brains. You are getting free consulting if you open up your ears and stop talking. So I tell entrepreneurs, when you're pitching investors, don't spend all the time talking at them. Start a dialogue, get them talking, show them your product. Wait, give them time to ask you questions. And when they ask you questions, go deep on these questions, really dig there. Why did you ask that question? Is there anything else you need to know? What do you think of my business? Are we on the right track? These are really important things because the investor, first of all, investors want entrepreneurs they can work with. They want entrepreneurs that they can contribute to, they can collaborate with as partners. So by simply not trying to sell them something, by actually engaging them, you are actually making them more likely to invest. And whenever anybody contributes their own ideas into something, they like it more. We all like our own ideas. So if you could get the investor really interested in what you're doing, and they have advice, and they're giving you advice, and you're really listening and soaking up this advice, they will start to feel some ownership over what your project is. And that makes them more likely to step up with the money and become more involved. So it's a win-win. You suck investors in And at the same time, you're getting their independent perspective, their ideas, which may actually be exactly what you need to go to the next level. Make it memorable. When you go in to pitch your startup to investors, leave them something that will make an impression. Now, I'm an investor. I take a lot of pitches, and I know the investors on Sand Hill Road, it's endless. All day, entrepreneurs are pitching them. It can get really, really boring. So when you go into their office to pitch them, make it a show. Try to get them, break them out of their mid-afternoon days and get them to focus. I always say, if you have a product, let's say you're building a robot, don't just talk about your robot, bring it into the pitch, let them play with it. If you are a food startup, a food tech startup, bring the food in there, feed the investors, let them taste it. It'll make all the difference. If you're a startup, I had an entrepreneur come to me in the very early days of VR. Like when most investors, they had never tried VR, they didn't know what it was. This was just right when Oculus was launching. They came in with a VR unit that they had built. And they sat down with me and they were like, Captain Hoff, can you help us with our business plan? Can you help us with our pitch? And I was like, just show me the VR unit. And they showed it to me and it blew me away. It was my first time trying VR. And I told them, forget about your pitch. Don't pitch them. Forget about your business plan. Just go in there, put the headset on them, get them to experience VR for the first time, and then answer their questions, and you can close a deal. They go, really? I go, yeah, you don't need the PowerPoint. Nobody cares. They want to try the product. And I will introduce you to a few investors. We'll see how it goes. Literally 2 weeks later, they had raised $5 million in venture capital from top VCs on Sand Hill Road. Create competition. When you are going out to investors, it's important that you create a sense of competition. Investors need to know that they may lose the deal if they don't move. Otherwise, a lot of investors, if they don't feel any competition, they will actually sit back and they will not commit the money. So I always say, use fear and greed. The fear of the investor losing this deal has to be so great that they are motivated to act. Now, it's kind of like a scale, and you want their greed for getting this deal to basically be more than their fear of losing their money. If you could do that, that's what gets investors from simply being passive to being active. Last one, number 10, when you want to close deals with investors, one thing you should remember is it's like kissing frogs. Every time you go out into the world of raising capital, each of these investors, each of these venture capitalists is like a frog, but you hope that they are your Prince Charming, and that when you kiss them, they will turn into this knight, carry you away, you will live happily ever after. However, most investors are just frogs. They will not fund your company. So I have a rule. When you go into investor, only kiss the same frog 3 times. And if they don't turn into a Prince Charming, they are just a frog. What I mean by this is that when you pitch investors, give them 3 chances to invest. The first meeting where you introduce yourself and your company. Now that they usually don't invest. The second meeting where you come back, then you have a chance of closing. So that it goes up exponentially. The second time you come back, there's a decent chance. The third time you go in to meet that investor, that's when you should try to close the deal. First of all, after the second meeting, you should say, is there anything you need to make a decision? Is there anybody else you need to bring into the room to make this decision? And then you get them to commit to that. When they do, and you go back the third time, try to close the deal. And honestly, if you don't close the deal after the third time, usually the odds start decreasing, and they decrease pretty fast. So strike while you can. Thank you very much. If you want to reach out to me, submit your business plan for investment or for our incubator, just go to founderspace.com. I'm also on all the social networks, just Founderspace. Thank you.
Thank you, Stephen. What amazing energy you have. I'm sure you're going to get a number of our participants reaching out to you. So thank you.
My pleasure.